pivot to getting the money right, flowing in the right directions, bridging the gap, de-risking and financing innovation. Basically, how do you get the funds to do the right thing along the lines that we all know are so important? Let me introduce our panelists. We've got Shaun Kingsbury, who's Chief Investment Officer of Just Climate, Rhian-Mari Thomas, who's Chief Executive Officer of the Green Finance Institute, Maria Carvalho, who's Head of Economics and Data at the NatWest Group, and last but not least, Heba Bevan, who is founder and CEO of UtterBerry. I'd like to, as with previous panels, just to hear from everybody briefly, right at the start, just to get a sense of where you're all coming from, so the audience know kind of what they're in for, like a little taster of the comments and perspectives that you're going to be sharing as the panel goes on. Should we just work along the line and see how we go, if that works? Shaun, what's sort of at the forefront of your mind when you think about, I mean, clearly not enough money is going in the right direction. I know we're going to get into some positive indicators as we get into the session, but what's at the front of your mind on this question?
I think the key issue that I'm thinking about a lot is how do we scale up? How do we drive more capital? We've done an amazing job over the last 10 years of scaling up wind and solar and batteries, but how do we get to the more difficult parts and the hard to abate areas of industry, and how do we scale up capital for food, land and agriculture? Okay, there's a bit of a taster there. Rhian-Mari.
Building on Shaun's points, the thing I focus on quite a lot is...
Could I ask you just to speak up a little bit?
Sorry folks. How do we set up the right institutional architecture in order to start bringing to market some of the blended finance solutions that people are talking about, that I think there's increasing recognition now that if we're going to meet our ambitious decarbonisation targets, we need to look at finance as the facilitator of real economy transition by sector, policy very much as the enabler, setting direction, but finance, we need to actually focus on figuring out how we use government money, concessional capital, and commercial markets working together to actually get them funding out of the door. Not going to happen by osmosis.
Okay, thank you very much. Maria.
I would say from NatWest's point of view, actually creating a demand signal from our customers, whether they're retail or commercial, to actually see the business case in investing into their transition. And so very critically here, it's about understanding the customer journey. What is the right financial proposition that can get them into investing into it? Because currently, when the business case is not there, what are the things that we need to unlock to make sure that the business case is there and they have the right financial propositions in place so that they can actually invest and do it?
Great, thank you very much. Heba, do you want to also just tell us a little bit about what UtterBerry does in your opening remarks?
Yeah, thank you. So UtterBerry is, we do a low power wireless sensor network with artificial intelligence and machine learning. We monitor some of the largest infrastructure in the world, including national and international. So tideway, tunnels, where we did Tower Bridge, Vauxhall Bridge, Blackfriars, Chambers Wharf, Stukas Wharf, as well as all the stations during Crossrail, some of them like Moorgate, Liverpool Street, Blackfriars, Farringdon. And currently we're doing projects in Australia, Singapore, Hong Kong, and these major infrastructure we have to monitor to the sub-millimeter, making sure it's safe to operate in certain conditions while they are tunneling underneath these critical infrastructure, or but they are building the infrastructure. And one of the things, which is your question, how can we actually facilitate the new money? I think one of the key points, we need to change our banking system and have a vehicle to actually help SMEs and new innovators to not just have the money there. It needs to actually help them to focus on how can bring in new ideas for net zero. How can you actually provide us with new methods to facilitate these ideas? Because currently, especially in the UK, our banking system doesn't support SMEs. If you are not in a revenue Anything below 5 million, you're basically not a focus. So new ideas and innovative engineering, it's a problematic area.
So maybe we could start with you, Heba, and your journey of trying to raise the finance to get your business growing, as you've described in these different countries. How hard was it to get the finance you needed? And you described...
You definitely got the wrong person, because I did not raise finance.
So how have you funded your expansion?
We had clients, we had customers, we had solutions. For 10 years, we've been having customers. We value our products, and our products, it's actually, and our clients need our products, because we offer something very unique that isn't in the market. It gives them a huge amount of reliability. So just to give you a perspective, to close any station during the build of a crossrail, it will cost London Underground £11 million per week to close Liverpool Street or Moorgate. £11 million multiplied by 52 weeks, you've got over £500 million of revenue if you shut down that station. If we keep up that station for you opening, and we keep it open for people to use, that's a huge of saving, but people don't talk about that saving, unfortunately. The same things will happen in Tower Bridge during Tideway. We monitored it for 5 years, never shut down. The basketball was open. As soon as they took our sensors, it got stuck. So we monitored them to the sub-millimeter, how they are expanding and contracting in real time.
But you mentioned in your opening remarks the difficulty for many SMEs to raise finance.
Correct. So UtterBerry's been going for 10 years. And for us to actually excel or expand, and I would say, give you an example, I lived in US for 5 years, and American market is very different than UK market, and taking the risk on a new innovative ideas is very different. I think as well, even how Europe look into innovative ideas is very different in terms of banking. And for us to expand to where we want, and that's why we don't have the Google of the UK or the Amazon of the UK or the Tesla of the UK, because we sell technology very quickly, like ARM got sold very quickly, I would say, and it's a massive international company, in not just in the UK, it's their patents in everybody's device. So that is actually the tricky part in the UK. We don't know how to scale up cooperation. We don't know how to make these small SMEs bigger. And it's very, very challenging if we don't have the right fund behind these, behind the SMEs. There's amazing ideas in the UK. We've got the best engineering in the world, and as well medical schools, and I would say even literature and history and art. And as a nation, we should enhance that by having a right banking system.
Okay, so thank you. So, well, there's an immediate point for Maria to tackle. I mean, is it right that the banking system isn't supportive enough of SMEs, and therefore potential innovation to help us get out of the climate crisis just isn't getting the money it needs?
Well, it's to the point on understanding the financial system. I would move it beyond banks to understand this, to Rhian's approach, is that when you have high risk, it's wonderful to see the innovation, but it also has a high risk. Can you really ask a bank that's under massive regulatory constraints on how they allocate their capital? Their risk profile is senior debt. And what SMEs need in terms of scale out, unfortunately, the main place in which that scale up occurs is through equity, because they're able to match that risk profile and they're willing to take on that risk. So what I would say is a financial system, which does exist in very well in the US, which is a mix of equity and then debt players. And so the question is actually, how do you get the financial system to work together? I know one of the things that we are looking at within NatWest, and we're really excited about, is how we're developing that support to SMEs in terms of accelerator programs. So we have a very strong accelerator program, which a third of it was actually towards climate and climate solutions, helping those SMEs scale up. But it's to Heba's point, is that they need actually, one of the other things that we're doing is supporting SMEs in the getting access to markets. And this is where we're thinking about powerful partnerships, where it's clear that the SME has a very great solution that can support our customers. And then suddenly you can help them scale up through a demand signal. And the question is, between that, how do you enable the kind of banking services they need to access senior debt? And that's just something that we're working through.
But I mean, presumably one could argue that if the banks were leaning into financing the transition to a greater extent, institutions like the Green Finance Institute wouldn't be needed. I mean, you're filling a gap that perhaps the market doesn't.
Yeah. I think that's right, but I'd really like to build on Maria's point, and I think I made this point to this conference last year as well. This is about horses for courses. It's about matching the right risk with the right type of financial solutions. And there are things, we don't want the banks to be taking huge amounts of early stage venture risk. And the regulator has rightly put the halt on that sort of risk taking, because we see what happens when the banks take inappropriate risk. We don't want that movie played again. So who are the right people who are taking that early stage risk? Well, the good news is that climate tech venture capital is on the up. London
in a climate supportive
That's
sense.
right. So very early stage, companies that are looking at their proof of concept, that are doing good climate tech work, can access venture capital money. Globally, that money has been down over the last year, but in the UK, which is now the number 2 climate tech venture capital investment hub, we saw it going up by 17% last year to 3.5 billion. So that bit seems to be working well. But the point Maria was making, and I know, Shaun, you're hot on this too, is then we have this missing middle, or valley of death, or whatever you want to call it, which is when you've got your proof of concept, but you're still not making revenues. And that is where, unfortunately, we are seeing entrepreneurs starting to look to the US, which invested over 300 billion last year because of the IRA, in that part of the patient capital before you're actually making revenues, which is when the banks can get involved because they've got visibility of future cash flows, and that's an appropriate risk for them to be taking. That's the bit where we need the policymakers, we need the philanthropists to start providing guarantees, to provide sort of revenue support mechanisms, and that's the gap. Thank you, David, for the advertorial, that the GFI plays a role, because that is not a straightforward puzzle to solve. It's multi-stakeholder, and it's very focused by sector.
You set up Shaun very nicely.
Yes.
I guess, Shaun, how big is the gap? What are the challenges with overcoming it?
Yes, it is a big gap, and we need these different flavors of capital. When we set up the Green Investment Bank in the UK, it was to deal with some of that gap. But I think there's a bigger role for private capital. We need to invest around $5 trillion a year from 2030. You can't even contemplate what $5 trillion looks like. And we're less than half of that. So that sounds really bad, but there's a lot of good news that goes with that. First of all, some sectors are really performing well. Solar deployed capital at a level that's indeed aligned with the Paris climate goals last year for the first time. They're on track.
Aligned with 1.5?
Aligned with 1.5, what they need to do. Wind has stepped up significantly, still not on track.
Because there were the supply chain issues that
there were supply chain issues and they didn't quite get to where they wanted to be. But where the next level of challenge is, where the hard areas are the hard to abate areas. Those are the areas that really focus on industry, food, land, and agriculture as well. On the industrial side, if you look at chemicals, steel, concrete, green hydrogen, these are all massive plants. They need a different type of capital than we've been talking about today. They're the next in the line, the valley of death. And the reason that they haven't been seeing capital flow is that it doesn't fit nicely into the capital allocation buckets that traditionally have worked. These assets are too big for venture capital, they're too asset heavy for growth capital, and they're too early for infrastructure capital. And so they fall between the buckets.
If you can, give me an example of a project that fits into that category.
We recently co-led a group of investors to fund a company called H2 Green Steel. H2 Green Steel is the world's first at-scale green steel company. And to give you an idea of why this is important and why this is a big idea, steel manufacturing, after concrete, is the second highest, most emitting sector with about 7 or 8% of global carbon emissions. If we're going to get on track, we need to store steel. And the scale of this is just huge. We haven't built a new steel plant in Europe in maybe 30 years. This gets away from the traditional blast furnace, which runs on coking coal, and switches to hydrogen. And the scale of this is just enormous. We completed a €2 billion equity round that went alongside a $4.5 billion debt and grant round, the vast majority of it senior secured project finance, to create a capital stack of €6.5 billion to build this plant. It went into financial close about 2 weeks ago, and there's a great big hole in the ground in Sweden, which 3 years from now will be producing green steel. These transitions are understood, they're known, and it's exactly what we did when we invested in offshore wind here in the UK 10 or 12 years ago, and saw it come down the cost curve. These transitions have happened before, and we should be optimistic.
I mean, with offshore wind, as I described earlier this morning, filming at Britain's first offshore wind farm, 2003, a sort of forlorn collection of turbines off the Northumberland coast, and it's staggering to see what we've got to now, but obviously took a combination of the right regulatory landscape, energetic companies prepared to take the risks, and the right kind of funding. I mean, Rhian-Mari, when you hear the story that Shaun's told us about the green steel, I mean, one might think that this is doable, that there are people prepared to lend the money, create the debt, and then we'll come to you, Maria, first. Yeah.
Well, absolutely, and Shaun's story, and congratulations on the transaction, needs to be replicated when we look at areas like sustainable aviation fuel, where you have exactly the same type of dynamic, which is, first of a kind technology, asset heavy investment, too big for venture cap, too early stage for infrastructure. But we can see how we can structure these types of transactions. We've been working very closely with our partners at Breakthrough Energy and with the UK government, and delighted to see that a consultation came out just this week on the types of revenue support mechanisms and mandate needed to accelerate our sustainable aviation fuel industry in the UK. But it's going to be the same in hydrogen, carbon capture storage, all these new sectors that are going to create the prosperity and jobs of the future. We need to figure out how do we actually leverage government money to bring in the private capital from the likes of NatWest and others. And the solutions are there. Right now, however, we don't quite have the right groups of people working on bringing these transactions to market. Which was my earlier point about the institutional, organizational structures that we need. I
mean, Maria's, thinking about the green steel example, yeah. I mean, we can all think of companies desperate to get hold of green steel so that they can meet their own scope targets of different kinds. One would have thought that would be an immensely enticing risk for a bank to take on.
I'll make 2 points. First is when government really does, like the contract for differences, which was the policy signal to de-risk financing of offshore wind. That was the reason why it could actually have senior debt, structure deals and work together to invest into that. In this point of green steel, it's the demand signal. So you're right, you say companies are desperate. I would argue that if companies, when they're looking at it, they're looking at what is the costs of steel procurement. And if green steel makes sense, then yes. If it doesn't, they don't. Like, one of the key things we're finding as NatWest is that you can put a green proposition out to support customers in investing into the transition. If the business case is not there, whether it's steel, whether it's regenerative agriculture, like farmers, everything from large companies to small, if the business case is not there, that the current fossil fuel heavy inputs is still cheaper to do and investments, because what you're really talking about largely, which we've seen, is the demand is not there to take even the green lending products. So where's the point? The key thing here is you need a very strong demand signal. Contracts
very strong...
a demand signal from customers that they are willing to invest into the transition. Mm-hmm. This is not about, that's the critical thing here. We are not seeing the demand that we need, whether you're a small player, like a farmer, all the way out to the big industrials who need to be decarbonizing. It's them that have to be coming to us and saying, like, I'm willing to invest into that transition. This is not the niche players, it's the large ones who have to buy.
But what's so interesting is the framing of this. I mean, in the context of the shipping industry, there's discussion about a green premium. Mm-hmm. Who is prepared to pay for a green premium for green ammonia, green methanol, or whatever? Yeah. But actually, someone at an event I was at turned that on its head and said, actually, what we're talking about is continuing use of fossil fuels attracts a dirty discount. Yeah. I mean, if you see it that way round, it's not a burden to pay a bit more for a greener fuel. And I'm wondering how that plays out in the financial world.
I mean, we provide discounted
funding. Because there are uncosted externalities, as we all know, from every time we burn any kind of fossil fuel.
Yeah, so, I mean, in terms of the green lending products, it's preferential rates for low carbon solutions, which automatically would then mean the fossil fuels is at a higher amount.
David, if I may use a direct analogy in the banking sector, which is when you're lending, the regulator makes you hold a certain amount of capital against each loan. And one of the arguments that people have made for a while is that for non-green lending, you should be penalised and have to hold more capital back. So it would have exactly the same impact.
Okay, so a sort of carbon premium then.
Yes. What originally was proposed is that green lending, because in theory over time should be more sustainable, and actually that's where you should shift your banking system, that should actually not be, you should actually be able to hold less capital against the green. But one of the reasons that isn't particularly attractive is then you're pitting two objectives from the regulator against one another, which is one, the stability of our financial system and making sure that banks are adequately capitalized, against making sure that banks are pivoting towards making more green rather than non-green investments. But a penalising factor would be something that would definitely be worth continuing to discuss with the regulators.
Heba, I know you said that you were financing your business through your clients rather than taking out loans from banks. But when you hear this debate, if I've understood that right, do you...
So if we want to scale up properly, we definitely will find funders and we will raise money, and we are in that process to do so. But even that, it's not just the funding. You need actually the right funders, the people who actually can make things drive better, and they can understand your vision as well. And it's very hard with this climate to actually get people to get your vision to expand and how to expand it within the UK and overseas. And there are very, very big hurdles that we have. When I mentioned the banking system, it's not just our banking system, it's our policies, of how we do things in this country. So just to give you an example, even if we win a very big international contract, our banking system is not actually able to guarantee it. Because you have to put, so if your contract is 4 million, you need to put a guarantee for 4 million, and the bank needs to put that. And banks do not do that. So we're like, oh, well, you need to have £4 million in cash, put it aside. For companies that are growing, they can't do that. You've got cash flow and you've got certain things. And for us, where we are, our headquarters in London and our manufacturing in Leeds and our innovation hub in Leeds, it's very challenging. And to understand as well what the type of funds that is suitable and who is actually, it's not, oh, well, great, we've got lots of people wanting to invest, but you need the right investor and you need the right vehicle that is actually, will get you somewhere and will scale the business right.
So what sort of structure or set of relationships would enable you to overcome those problems?
So when we need to change certain policies in the UK, so for example, if you look at FTSEs compared to NASDAQ, in terms of investment, most of our pension funds in the UK, it doesn't invest in tech. They're not mandatory to invest in tech. Where in the US, most of the pension funds, they're mandatory to invest in NASDAQ in the tech. And when our pension funds want to invest in tech, usually they will invest in NASDAQ rather than FTSEs, which is actually, it makes it not appealing for even tech companies to be here, and to think about going IPO or listing in the market. There is other stuff which is our regulatories and certain things that we do in terms of patents and in terms of incentives. So great, the government have a patent box, so as a company who's heavy in patents, we definitely utilize patent box and R&D tax credit. But that is not actually, it wouldn't put us similar to other companies in overseas, because if you're trying to compete with them, you need to have literally an even fair ground. And currently, we don't. We pay a business rate, we pay national insurance, we pay taxation. We have a huge amount of burden as companies and corporations, as an SME. And investors don't understand there is these kind of parts which comes into the equation, but we're trying to, as well, when you have your employee all in the UK, it's harder to understand as well different cultures, because you have to have people on the ground, say in Australia or in Singapore, because there is a culture part of it where our investment, they don't understand. There isn't a mechanism that I can hire one person overseas and have them in my payroll. It doesn't work. It's called consultant rather than being part of the company.
Yeah. So what's so interesting about this is obviously plenty of potential money swilling around in the global system, and there's this desperate need to get money flowing in the right direction. Shaun, what's holding it back? I mean, what do investors need, or financial institutions need? What more do they need?
I think we need more flexible capital to begin with, because if we stick to the traditional buckets of capital that have worked so well in the past, of venture and growth and buyout and infrastructure, they don't match the opportunities that we see today. Because if you're going to build a SAF plant that you mentioned, or long duration energy storage, or green hydrogen, they don't fit those capital allocation buckets.
But sorry, forgive me for not understanding this. If you wanted to build a new coal-fired power station, isn't that exactly the same?
No, because there is a structure there that would have secured your offtake and your revenue stream, and that would have qualified as an infrastructure investment, because you have a high degree of security and foresight on what you're going to receive.
But if you built a green hydrogen plant, surely you could have the same offtake agreement.
You could have, and that is the challenge of getting the markets to work and the developers to work together to create CFDs or fixed offtake agreements, and volume and price need to be thought about.
Demand, because as Maria was saying, the demand isn't quite there yet.
The demand, I would argue, is there, but the structures and the capital that matches that risk. Because imagine you're building, I can't imagine building a coal plant, by the way, but imagine you were building a coal plant. You might be building the 300th
parts of the
coal
world.
plant.
Yeah.
Imagine you're building a global scale green hydrogen plant. It might be one of the first 10. And so when an investment committee or a credit committee looks at that, they'll say, show me one that's been built. So we need more flexible capital, and we need developments which understand how to finance these things. They are possible, But if we stick to the traditional models, it's more difficult. And so we must reach out to the pension funds, and we must reach out to the institutional capital and say to them, you've all made commitments under science-based targets. You've all made a commitment to the Paris Climate Accord. The portfolio that you hold today, is it aligned with a 1.5 to 2 degree world? And in many cases, it is not. So when I pitch the idea of providing capital to something like Just Climate, which takes these risks to solve these problems, I say these are higher risks, but you will see higher returns. But as you look across your portfolio, a lot of what you hold today has carbon downside. As carbon prices go up, as carbon regulation goes up, the portfolio that you hold today could see impairments. You need to balance that portfolio, and you need things with some carbon upside to start to get on track. And therefore, if you're looking for those, and they're much harder to find, by the way, that's exactly the type of investment opportunities we structure and we put together. And so, let's not argue that what we're doing fits your existing buckets. Let's turn that argument around and say, if you're going to balance the portfolio and stick to the commitments that you've made, you need investments like the ones we'll create.
So, Rhian-Mari, does that thinking help unlock, or would it help unlock the scale of flows that are needed? I mean...
Yeah, absolutely it would. The point I'd like to make is the finance industry is no different to any other industry in that it has honed itself to efficiency. It has set itself up so that it can maximize profits from the way the economy has been set up over the past decades. And now we're asking it to do something different, which is take risk on things where it has no visibility on future demand or future price. You build a hydrogen plant, and you also have to worry about technological obsolescence, about potentially your demand won't be there. You've got absolutely no way of extrapolating historical trends so that you can say with any certainty what the price for that product's going to be. That is a huge risk. And yes, there's enough money sloshing around the system, but you can quickly see, well, I could leap into the unknown over there, or I could keep cranking the wheel on what it is I already do very efficiently that is perfectly legal to do, and invest in things that I understand with familiar business models that I have been set up to do. That is what we're trying to deal with. Can I just give one example that maybe brings this to life for the audience a little, and it's about electric vehicle charging. So we know the sort of chicken and egg issue about electrical vehicle charging. People want to develop the charge points, but they don't know if anyone will use them. And equally, people want to buy electric vehicles, but they're like, I don't know if I'm going to be able to charge my car. So we went and worked with Orkney, lovely place, very far away, in the north of Scotland. And they have a glut of electricity. And so they were very keen to start a charging network, but struggling to finance it because they weren't sure how much utilization would happen. So my team, and actually Juliette Flamanque, who's been leading this work, is in the audience, devised with the market a utilization-linked loan. So actually, the lender, in this case a Dutch bank, doesn't require repayment of the loan until utilization hits a certain threshold. Right. A bit like a student loan, I guess. In order to do that, however, the credit committee is sitting there going, I have absolutely no idea what utilization is going to look like in the future. I've got no data. So they needed a guarantee for a portion of that in case it all goes horribly wrong. And right now, when we looked across the public finance architecture...
who gave the guarantee then?
Somebody needs to provide a guarantee. So if in 5 years' time the utilization hasn't hit the right threshold and the developers say, do you know what, we're not going to repay, the bank recoups some of its money, 20% in this instance.
Right. Yeah.
Right now, going to Shaun's point about we need more flexible funding, we couldn't find anyone to provide that 20% guarantee. Organisations aren't set up to do it. I think it's the point you were making as well, Heba. We had to go to a philanthropist, one of our backers, and they've actually stepped in to help us get this pilot off the ground. Spades going in the ground next month on some of the charges, and what's really interesting is that it's become a real community project because the people that have applied for the loans are the Airbnbs, the bed and breakfasts, the small convenience stores. all of whom are really excited about actually turning Orkney into somewhere where you have chargers everywhere where you park your car. Isn't that a great example?
I'm just wrestling with whether that's a good example, because you've overcome the obstacles to find a way of getting this off the ground. But is it also a pity that it took philanthropy to provide the unlocking?
It's the nature of disruption, and it's the point I think we've all been making. It's about finding the right people who've got the right risk appetite.
Yeah.
And we do need the philanthropists to do more venture philanthropy.
Yeah.
So that's a shout out to any philanthropists in the audience.
Yeah.
But the important thing here is you do the pilot with philanthropy, then you've demonstrated how it works. You've done the heavy lifting, you can take it to government and say, now let's scale it across the country and build the 300,000 charging points that we need. You provide the guarantee and the banks will pile in.
We're entering the last few minutes. That's a great example. Maria, when you hear that example, but that it took a philanthropic foundation to provide the missing link, for you in the banking sector, what does that make you think? That it's a wonderfully innovative way to progress, or that maybe banking should offer more and be more flexible?
I mean, genuinely critically, it's being able to actually have different financial players work together in terms of a blended finance approach to scale. Because each one of us has different risk profiles, different ways, but we reckon, and we play an important role at different stages of the solutions and scale-up journey. So critically in that is actually what I think a better financial ecosystem that can connect up in such a way that you allow for that. And I actually think there's a very important role for public-private finance to enable that as well. Because it's not just philanthropic and concessional capital. The UK Infrastructure Bank plays such an important role on the very large-scale investments that are there. We are paying attention to what the UK Infrastructure Bank is doing, because those are the kinds of things that can help in the de-risking. So what I would constantly bring forward is a financial system that works together to really have a vision of what net zero needs. Where does each financial player play a role in that? In a blended finance approach, but even with government, public-private finance. These are the kinds of things that we have seen, which is the untold story, but I think Mariana Mazzucato does a very good job of showing it, the importance of public-private finance to create real change.
Okay, thank you. Look, we're really into the last minute or so. Heba, I want to give you the last word, Heba. Give us, just in a minute, the one thing that would really make the biggest difference when it comes to finance.
I think definitely an agile finance that able to sustain and build SMEs in this country and fund innovative ideas, which is sometimes, even if it's blue sky, high risk, high rewards, as we've heard here. And I think there is a huge opportunities for our bank to change their behavior, maybe their policy and adaptability, and support the new generation, especially with the outcome of the huge number of innovation in greeneries and in green technologies. And there are opportunities around that to bring in a better sustainable future, but we really, really need to evaluate where is our risk appetite in this equation.
Great, that's a good note to end on. Thank you all very much indeed. Would you all join me in thanking a brilliant panel? Thank you. Thank you very much indeed.
Thank you.
Thank you.